Hey everyone, thanks for coming out today. I really appreciate the opportunity for all of you to join us here for our first InsurTech New York event. Just only 2 months ago, Tony and I were really talking about this insurance ecosystem in New York. And there had been a number of reports that came out from Venture Scanner and some others that said that InsurTech is the capital in New York. And we were thinking, well, how come there's not a greater ecosystem or community of people together? In fact, the Global Insurance Accelerator is in Des Moines, and AXA, who, there's a couple people here in the audience, they have a big accelerator out in Silicon Valley. But we needed a community, and there are a number of organizations that have come about, including Quesnay and InsurTech Connect, that has put together a lot of people all to Las Vegas. But specifically for New York, there wasn't a recognized brand, and that's our goal. Our goal is to be a community-centric organization that pulls together carriers, brokers, startups, and investors to all support the transformation of the industry to a digital-first insurance world. And what we want to do is provide you guys with quality content and bring together really great panelists like the 4 that you guys see here and give you opportunities to network. So I'm going to pass it off to my co-founder of InsurTech New York, Tony, to kind of share some more words.
So thank you. So we are extremely excited about today's panel session, obviously, but I do want to make you aware of our future events as well. So our next InsurTech New York event is actually not going to be in New York, but it's going to be in Las Vegas. Right before InsurTech Connect, we're going to have a pre-event activity in Las Vegas. So look forward to meeting you there. And the following 3 events are going to be in New York. So the October event will be a panel discussion on customer engagement and the future of distribution. In December, we'll learn about making InsurTech POC work for real. And then finally, just in time for Valentine's Day, we're going to try to have InsurTechs or carriers or brokers find their soulmates. And we might actually help you with some marriage counseling as well. All of the event information will be on our website, insuretechny.com. And we'll be also sending you emails for those of you who attended. So we really look forward to seeing all of you in the future events. We could not have had this event without our space sponsor. So I'm going to first now pass it off to Joseph here, who's going to talk about what they do in McCart English.
Thank you, Tony. All right, so welcome everybody to this first Investing in InsurTech Fad or Long-Term Value event for InsurTech New York here at McCarter English. McCarter, let me tell you a little bit about my firm. We've been around for about 175 years, and we're basically a firm that has a department for everything that a business would need, right? So, real estate, litigation, corporate, intellectual property, tax. We have 400 lawyers and 9 offices throughout North America. I'm co-chair of the 50-person venture capital emerging companies practice. And this basically focuses on formation, financing, growth, and exit.
Thank you, Joe. So we also want to just point out our many volunteers and also community partners who's helped us host this event and make this a reality. So our community partners are Startable, Black Bear Life, and LifeGenic. Startable is an early stage InsurTech startup advisory. They help early stage startup go from seed to Series A, helping them in product market and funding strategies with focus on InsurTech. And Black Bear Life is a new life insurance company that is complete digital. And finally, LifeGenic is an industry-leading provider of virtual remote inspection solutions tailored toward the entire insurance ecosystem. Representatives of these partners are all here, so let us know if you want to connect with any of them. And now let's get started with the main event. So panel discussion on topic of investing in InsurTech. Is it a fad or long-term value? It's a question mark. Okay. So our moderator for the panel is David Gritz. David is a partner in Startup Owl, where he has a track record helping startups go from seed stage to Series A. He leads innovation programs for SVIA, which is Silicon Valley Insurance Accelerator, and has mentored and advised more than a dozen insurtech startups. I'll now hand it off to David to start the panel discussion.
Thanks, Tony. Could you offer the mic up? Thanks. So, really grateful to have such a tremendous panel here today. The panel we have is really a mix of the entire industry. On one end, we have the second largest reinsurer, one that provides capacity to many of you guys who are carriers here, but they've really taken a unique approach at how they look at investing. And Stephen and I had a number of discussions at how some of the larger reinsurers are kind of just making bets in everything, but Stephen really wants to have an approach that's thought out, and he's going to share more about that. Going down the line is Adam. Adam's at Guardian Life, and he has a background in corporate finance and investment banking. And what he is really looking to do is to take this $100 million fund that they have and make strategic investments that hopefully can change the way that life insurance is done. And what's really cool is Adam and I were talking earlier, and a lot of the very interesting life insurtech startups that I've known from Silicon Valley Insurance Accelerator or other events, Adam's already had conversations with them. So he's doing a really great job at finding the people that have the opportunity to make the impact and hopefully seeing if they're worth investing. Farron, next in line, he's the only one on our panel that's actually switched over to the light side. So he's an entrepreneur now. His background is at RGAX, leading innovation over there. He started a VC called August Era. Actually, Farron and I met about a year ago. He came to a Silicon Valley Insurance Accelerator event we had on blockchain, the other fad. And he had some really interesting things to share because he was part of B3I. And for those of you who are not familiar, Stephen's organization is one of the main people that started that. And B3I was focused on bringing people together for blockchain in the insurance industry to create one unified group. And then last, and certainly but not least, is Nitya. And Nitya's from Tribeca Venture Partners. And why I think Tribeca Venture Partners is such a great choice for this panel is because they focus on investing in New York. And their goal is to support the broader New York ecosystem. And I'm hoping Nitya can be a little bit of like the Simon on the panel, because a lot of us here are in the bubble. We're in the insurtech bubble. And she looks at deals that are much bigger than insurtech. She looks at finance deals, she looks at AI deals, other tech deals, and hopefully her perspective could be really valuable to us to see, is insurtech really a fad, or is it something that can produce long-term value for the industry? So to have each of the panelists start out, I thought what would be really valuable is for us to hear, what is insurtech? How do you define that? Everyone has their own opinion of it, what's included, what's excluded. So give us in a few sentences, what is insurtech, what's included, what's excluded?
Yeah, thanks, David. For me, insurtech means either a tech-enabled insurance company or business, including MGAs, or a tech company that serves as its focus the insurance industry.
I think about it pretty broadly. I'd say it's any tech company that touches the insurance value chain. So that can be anything from direct-to-consumer business selling insurance to a company that's enabling a carrier or a brokerage to better understand their customers or optimize business process. I think that the company doesn't necessarily have to be solely focused on the insurance industry to be included in insurtech, so long as they touch the insurance industry is fine.
Yeah, so I mean, it's slightly different. I think of it as it's the asset class of private companies that investors want to generate big returns in. You know, so when I was investing actively and more passively, looking at companies that we could get a 20, 30x return on. So not really just like an insurance company that does tech, because tech is part of a very, very large part of our OpEx when I was at RGA or at Aviva.
Yep, I would echo what all of these guys have said. I probably would echo Adam the most here in that it's really, we have a pretty broad definition of insurtech, any sort of tech or innovation that's touching the insurance industry. And to Farron's point, when we're looking at investing in an insurtech company, it has to be a company that can grow to be ginormous, but I still think insurtech companies can be even the smaller ones.
Yeah, and I think the panelists did a really good way of looking at it, and from a lot of the VCs that I've talked to, the definition is much broader than just your traditional MGA distribution play. That InsurTech, and even Brian and I were talking from Empire Startups about that there's a lot of different areas that InsurTech covers, whether it's payments, whether it's digital health, and I think the more encompassing we can be, the more effective we can be at helping carriers to kind of transform. So I would also like to ask the panelists to kind of share for the information to the audience, what area of the value chain do you support? Are you in pre-seed, seed, Series A, or Series B? And I know that's not a fair question for you, Farron, but maybe you could talk about what stage your company is and what companies invested or the ones that you can disclose.
So we are open to investing all along the insurtech industry. I mean, we're very broad that way. We're industry agnostic in general, so we're very open. In terms of what stage we like to invest in, we're early stage investors, so we're typically sitting at the Series A, so that means companies with around $1 million in annual revenue, just as kind of a benchmark to throw out there. But we do some seed investing as well.
Yeah, so I mean, previously when I was at RGA, running our investment function there, we were very, very comfortable with seed, and I think that was like actually probably this. I mean, selfishly, I think that's the smartest way to do it in insurtech is like invest in the seed and take pro rata up to the A and the B, just because our balance sheet, you know. Anyways, and then now that investing off my own personal balance sheet, looking more at like pre-seed deals, so like less than 4 million valuation, pre-money valuation.
We tend to be Series A investors. That's our sweet spot, and I think the rationale there is that we like to use the technology that we're the company kind of strategically within our business. We also like to be very influential with the future roadmap of that company, and then with our check size, I think that kind of leads us towards Series A.
I would say we're pretty stage agnostic, although we looked at a company recently where we were going to be their first institutional funding. At the same time, I think the maturity of the company compared to these guys, we're probably more on the later stage, call it even C or D later. If you look on Crunchbase, you'll see us make a lot of more seed investments in 16, 17, and now through kind of that experience where we're definitely later stage larger checks.
Great, so you can see that the panel makes up a large swath of the investment stages from pre-seed with Farron all the way up to C or D with Steven. So I wanted to really jump in and first talk about the industry outlook and some of the opportunities in the space. And there's been a lot of debate recently on what areas or lines of business and insurance can produce the most value. So first question is for Steven. Steven, since Swiss covers both sides, both P&C and life and health, where are you seeing the most opportunity? And the answer could be both, and maybe you could give a couple examples.
Yeah, I think we see opportunities in both. I would say on life, definitely more on the distribution side. I'm actually more excited about P&C because I think the beauty of technology is that you can make things more efficient and also use data more accurately, appropriately, both for underwriting and cost. And I think with a lot of the machine learning and AI opportunities, you're really talking about high frequency, low severity risk. When we're talking about low severity, high severity, low frequency risk, very, very difficult, I think, to apply machine learning, just not enough data or history there. So from that perspective, I think P&C, more exciting for me for InsurTech. Having said that, a lot of life opportunities out there.
Yeah, so moving on to Adam and Farron, I would be curious within the life and the elder tech and disability space, where do you see, not just now, but like within 3 years, a lot of the opportunities coming? Because it seems like a lot of the low-hanging fruit on the distribution side has been taken, but where do you see a lot of that coming?
That's a good question. I think within our business, it's better utilizing our data with companies that can help us through machine learning to kind of optimize our existing policyholder base, we think there's a lot of opportunity to partner with companies and find companies that have those capabilities that can better identify who's underinsured, identify who's going to lapse, and then really target how to communicate with them. So I'd say kind of data and automation plays with our existing customer base is a huge opportunity.
Yeah, so no, I mean, my previous investments like Fabric and Ethos, I think the digital direct-to-consumer quasi-carrier space is like now crowded. Like it's actually very, very crowded because there's, let's call it 8 really, really good, strong teams there, and they're well-financed, like Policy Genius being the most notable here probably, and then Fabric as well. And then, so yeah, no, I think like elder care actually is like something that's super, super interesting. Definitely under-invested as a percentage of GDP, population growth, like every metric you think about. And then there's some really interesting stuff because like largely it's unregulated. So you don't have to deal with like the nuances of 50 different regulators and stuff like that. So definitely that's something that, I was actively, like I am actively angel investing, and then my company, that's what we raised some capital to go after a problem there.
What are some examples of the categories within elder care?
Well, I mean, so from everything from like digital direct-to-consumer diapers, right? Like adult diapers, like they suck, like if anyone's ever worn one, like they're not very comfortable. And then just like the stigma and like all of that like is like terrible, up to like Internet of Things like fall detection software, right? We previously invested in a company that does caregiver burnout support, right? Like called T-Care out of St. Louis. And I mean, there's like just every aspect of the fact that, the first boomers turn 75 in 2 years, and then it's going to be 20% of the US population by, I think like 2025. Like I'm just making up the number. Huge, huge, huge. And then that's just like pure like physical stuff that's happening. And then when you think about like the pensions and like the decumulation opportunities that are coming in intergenerational wealth transfer, I mean, there's huge, huge, huge problems. And then you layer on fraud, and like stuff like that. It's like, it's massive compared to, like digital direct-to-consumer life insurance, where I think like that is like done, right? Like it's like Ladder, Ethos, Fabric, Policy Genius, Health IQ, like Bestow, like that's it. Like it's pretty hard to do something else, even if you're trying to do like MGA enablement stuff. I mean, that's my personal view. But.
No, it definitely makes sense, and hopefully that gives people some ideas. So last I wanted to get to Nitya, and I think in our earlier discussion, one of the things that we talked about was that you had reviewed a lot of deals in InsurTech and maybe haven't made any investments yet, but you felt that there was a lot of overlap with some of the FinTech areas. So I'm just kind of curious, from the deals that you've seen, what are some of the categories or companies that maybe are not purely InsurTech but overlap, or areas that you think InsurTech investors should be looking at?
Yeah, so when it comes to InsurTech, we haven't made an investment yet. You're correct about that. But we are really excited about it. So we've looked at a lot of the InsurTech companies in the New York ecosystem. And our thesis around InsurTech is really predicated on a couple of things. The first is explosion of data sources. There's so much data that can be used, whether it's for underwriting, automating processes, optimizing pricing, segmenting risk, all of that stuff. The second is unique distribution strategies, and the third is improving the customer experience. I think a lot of people can agree that incumbents haven't always provided the best customer experience, and especially now as they're looking towards millennials as their new customer base, they're trying to figure out how to tap into that. So we're looking for all three of those things when we do make an InsurTech investment. In terms of how it relates to other industries that we look at, we look a lot at FinTech. We have a pretty strong FinTech portfolio, as well as under other industries. And I think, especially in FinTech, you're seeing a lot of those same trends. So whether that's improving customer experience for student loan refinancing, like one of our portfolio companies, Common Bond, or whether that's all the new data sources that can be leveraged. I mean, every company at this point should be doing that. So those are pretty common trends we're just seeing throughout.
Yeah, so I want to shift the discussion a little bit to the challenges, because it's clear that there's a tremendous amount of opportunity, but really to create long-term value, you have to be able to overcome the challenges. And Adam and I were talking about earlier that one of the most common challenges for InsurTech is the ability to find a carrier partner. So if you're working with a carrier for distribution, or if you're a claims application like one of our partners here at the event, you need to have those carriers that buy into your vision and are willing to walk through a lot of the challenges that happen in procurement. So I'd be curious, both from Adam's perspective and Farron's perspective, what are some of the key challenges in distribution in terms of working with the carriers, and how do you overcome those?
Yeah, this is a problem that's near and dear to my heart because we live it every day. Where we've been most successful is in our investments, really, kind of in a sense, forcing the business to use them, because we've got senior management's, support to kind of change our business and use those investments. But I think if you're just trying to get in, and finding that business person, it can definitely be challenging. So I'd probably say think a little bit outside the box with who you're going to contact at carriers, and sometimes you need to find more innovative people than the person who's responsible for claims or distribution or underwriting. Maybe it's head of analytics, maybe carriers have a head of innovation, maybe it's someone on the technology side, certainly on the venture side. That would be my kind of best advice.
Are there any carriers here? Okay, good. So apart from Guardian, in general, carriers on the life side, oh my goodness, it was the bane of my existence. Because, no, exactly to your point, right? Like, everyone can say no, no one can say yes, right? Like, legal can say no, compliance can say no. And like, you just run down the food chain. Like, we would meet with like the C-suites of our former clients as a reinsurer that pay us $400 million a year, and like the CEO would be like, Steven, get this done. And then like 2 months later, it just doesn't get done, because like people well below Steven would just be like, oh, well, what about this, what about this? And then the challenge is the business is so complicated that no one really understands it, right? Like, financial reporting doesn't understand valuation, valuation doesn't understand claims, like just, you understand it, but like not the intricacies. That makes it super, super slow, super painful. So yeah, no, I agree. Like, I think like trying to find an internal advocate is an absolute necessity, but then at the same time, I think you have to be like thoughtful, so what I would say is, depending on the stage of maturity of your company, taking strategic capital from a corporate venture fund is actually sometimes like a really bad thing. Just because from what I've seen, it's very easy for a innovation unit, I speak as like a recovering one, or like a corporate venture capitalist, to just play like football with the startup, right? And just like pick it up and like just throw it into the crowd, and like someone will catch it. And then that's fine, because to your point, like you're getting paid and like you're on a 401k and whatever. Whereas like for startups, it's like, oh, like feast or famine, right? Like you have a burn rate, you're eating free sandwiches, and stuff like that. So yeah, I don't know,
Yeah, maybe a follow-up for you, Farron, and I know you've been away from RGA for a little bit, but with their investment in Cookhouse Labs and a lot of their innovation, I've had conversations with some of the current team, they're kind of feeling like they're tapped out. Like, we have so much stuff we're implementing, and I had a discussion with someone from State Auto, the same thing. How do you think that the carriers can overcome the challenge that we just have too many new projects and like it's just too much to handle?
Yeah, no, it's a good question. So I think it's like, so I don't know the solution to solving, because each carrier is unique. And I think to even Adam's point, right, like I remember I was talking to the CFO of whatever, the 7th largest life insurance company. He was like, oh, my job is so easy to plan because we have a 100-year-old book, right? So it's like everything we do is baked in. Like even if we like grew sales by 40%, that doesn't matter. Like the only thing that would matter is if we reinsured everything and fired everybody in the company. Otherwise the plan takes 2 seconds, right? Like it's like, just change the year in 2018 to 2019, we're done. So that's kind of the real challenge, right? And then so I think, so for carriers, I don't know what the solution is. I think for like startups or like service partners or VCs or whatever, I think the most attractive thing is finding the smallest, narrowest problem that hits one person's, budget, right? So it's not like you're going to solve like the head of claims problem is, you know, the time it takes to get an APS, like an attending physician statement, right? Like it takes 40 days, costs $200, solve that problem, that gets solved, like that's easy, like it's a small footprint versus, I don't know, like trying to fix like a policy admin system or something, or like an illustration system where like it touches way too many people, no one's going to be satisfied. So yeah, I don't know if that like answered the question or gave that much insight, but that's what I'd say.
No, I think it was solid insight. So the last area that I really wanted to cover is just thinking about the long-term value equation. And there's a lot of things that have to happen into that. You have to overcome the challenges, there has to be opportunity, but I think most importantly, there has to be a pipeline of really quality startups that are moving along. And Adam and I had a discussion about that there's not a lot of organizations that are willing to do seed, especially in InsurTech. And I know, Stephen, you're on the other end of the equation, so you have to wait until it gets to a far enough stage that it actually makes sense. And last time I counted, there's only around 7 accelerators that are actually making investments into InsurTech. So I'm curious, from your perspective, Adam, and from your perspective, Stephen, what do carriers do to make sure they have quality pipeline 5 years from now from the small amount of accelerators feeding people all the way through?
Sure. Yeah, it's a tough one. Like when I think about our fund, we don't do seed investments, and that's really because we're strategically inclined to utilize the companies that we're investing in, and seed stage is just a little bit too early for us. It depends on the company, but you know, generally speaking, they haven't launched yet, and so it's really tough to kind of hit our mandate with those investments. I'm not sure how to answer the question, to be honest. It's a really tough one. You know, maybe it comes outside of kind of corporate venture capital, and maybe it's more traditional venture capitalists who can fill that void. And maybe some of the corporate teams that kind of sit outside the business. So I know some of the carriers have teams that you know, kind of invest in financial returns are their primary mandate, and they're not necessarily utilizing the companies they're investing in their business. Maybe they fill some of that gap, but for us at least, it's a little bit of a challenge.
Well, maybe just a quick follow-up on that. So there's a number of carriers that are making investments to other organizations to direct their investments, like IA Capital is doing a really good job, and OnRamp has partnered with Alliance Life to do that. So maybe just for you specifically, would you make an investment in a third-party group that's going to direct that for you if they were going to do seed investments?
Theoretically, yes, I would, although that is not within kind of the mandates of the way our fund is set up. So the real answer for us would be no, as it is today. You know, and I think it comes back to the utilization mandate, right? We're you know, have a mandate to utilize the investments to try to move our business forward today, and so I think that creates a bit of a challenge there. But theoretically, I think it's a good idea, and I think it would help with the pipeline.
Okay,
We're
yeah,
very close to
Stephen,
it.
curious your perspective.
Trying to answer the question 2 ways. First one, kind of harking back to what Farron was saying. You know, we're a large company, and what that means is we're slow to say yes. It takes a lot of people to say yes to get the yes, and we're very, very slow to say no, because if everyone says no, I forget to let Farron know, or you know, we just figure we don't need to let them know. We don't let, you know, we'll kind of let them wait. So what that means is because we're so slow, I don't actually feel like the pipeline is like, you know, there's a dearth of opportunities, because we're slow moving, and the opportunity, there's so many out there that we can cherry pick, given how large we are, the best ones to work with. So that's kind of the, unfortunately for InsurTech, I think that's one way to look at it. You know, you mentioned, David, earlier that kind of now we're on a later stage. I think that's also another part of the problem. When you do find an internal champion, and that's how you measure strategic value, what happens when that champion leaves? Your investment becomes orphaned, or someone forgets it. And I think that's kind of what we saw internally with our 2016, 2017 kind of seed investments, and kind of why internally we've now moved towards larger strategic deals where we can measure strategic value based on commercial value. And when you can measure commercial value equivalent to strategic value, then you're not worried about orphan investment. And you can afford to move slower because for those investments, we can throw a lot of money at it, knowing that it'll pay off, both from an equity value perspective and also from a commercial value perspective. So I think, and that's something born out of experience, right? Like, and I think the investment mentality is also different. When we do investments like that, we want to make sure everything works, and not a portfolio where, or not a portfolio where we just need one investment to work to pay for everything else. And I think both could work. You just have to know for your organization which one's the right strategy for you.
So one thing before you go off that, Stephen, I was curious because we had the discussion about you guys want to help in more than just investment, but provide capacity and some other things. And maybe kind of we could go down the line, but what do you think is the responsibility of carriers to provide outside of capital? And do you think that they could become a strategic partner without making investment and provide value?
Right. So I think from Swiss Re's perspective, I think we're from a position where a story is great. We want to hear about the management team. We want to know it's a strong management team, but you need to show us your product works. And the way you show us your product works is not just one meeting where you do a demo. It's actually when we provide capacity or paper, show us that your unit economics is actually the right side up, that you can actually deliver your risk profitably, and not just grow at all costs. And I think the way the show me works is by providing capacity or being a POC, and that's why. And I think that strategy, because we think that way, moving slowly is not such a bad thing.
Yeah, Adam, you want to take that too?
Can you just give me the question one more time?
Yeah, of course. So the question was, how can you provide strategic value outside of investment, and do you think you would partner with startups to do that?
Yeah, absolutely is the answer. Not every company that comes in the door from our group is a company that makes sense from an investment standpoint, but it can often make sense in terms of moving our business forward. And so I think just having really close partnership with our businesses, continually bringing them ideas, I think is very important. And it works both ways. Sometimes the business will find a company, use them, bring it to our attention, and we'll ultimately become an investor. So yeah, absolutely.
Great. And I guess, Farron, maybe you could speak from both sides, what you're looking for in carriers that you partner with, and kind of from your historical perspective on that.
Yeah, no, so I mean, I think it's like, there's a lot of value carriers can provide to startups. Just even understanding the jargon, the landscape, like the KPIs, other introductions to folks that might move faster than, the big, very global, football stadium sponsoring names. And then, what do I look for? I don't know. Just like, someone who will do what I want to get done, I guess, selfishly, right? Like if I'm looking for capital, like not looking for capital from strategics, but or a partnership or an appointment, I think that's what I look for.
Yeah, no, that makes sense. So another question for you, Farron, and I think an essential thing in providing value up front from the startup perspective is coming up with milestones that are reasonable, maybe beyond just revenue. And I'm curious, in your thinking and the VCs that you worked with, how did you design milestones that you could be measured by that were outside of traditional revenue or profitability metrics?
Yeah, so I mean, I want to talk about the current business that we're running or that I'm running. But I would say, like, particularly in insurance, it's so hard. So like, even like the nomenclature of like a Series A, doesn't look the same. You know this way better than anyone, right? Doesn't look the same. So even like some of the Series A's you do, it's like the Series A is like, we sold the first policy, right? Like versus a traditional like enterprise SaaS Series A would be whatever, minimum 2 million ARR, growing 15% month to month, like that just can't exist. And so thinking through that thoughtfully, and then the amount of capital that's required, and then that varies like life versus P&C, because like to Stephen's point, there are some auto insurers that are growing phenomenally fast, But I think what they would argue is the reason why they have to grow phenomenally fast is because they're buying claims data, right? To cherry pick risk, to be able to think about how to take on Geico, right? Which is like the elephant in the room. So yeah, I don't know. Like I think like that's like the thoughtfulness around like how you think about capital, how you think about distribution, because like insurance by and large are like, you know, products that are pushed, you know, not purchased. And then how are you thinking about like governance, really, and those metrics to like find someone else who will continue the journey 18 months down the road, whether that's with a Series A of like $8 million, whether it's a Series B of 30, et cetera, et cetera, et cetera, up to like a $200 million, you know, Series C or later.
Sure, that makes sense. So given we have limited time, I wanted to ask one question to the whole panel, and we can start with Nitya, but the ultimate question of the panel today is InsurTech a fad, or can it create long-term value? So I think there's a lot of different ways that you could answer that, whether it's as a VC, you guys think that you're going to get a reasonable return on your capital, or it could be, if you guys are a carrier, do you think that the insurtechs that you invest in are going to increase your share price over time?
So high level, I don't think that this is a fad. I think from an innovation perspective, I mean, every industry needs to undergo, you know, innovation for it to improve, and insurance is a huge part of the underpinnings of our society, and so any, you know, innovation that can be brought in to improve that is a good thing. I think from a venture capital's perspective, I think one element that you could say is a fad is that I would say 2017, 2018 valuations were very, very high for insurtech startups, and I think those are going to start coming down a little bit. It just became like the buzzword. So I think that is a little bit of a fad from that perspective. In terms of will it return the fund, or how we think about it really growing and becoming huge, I think, you know, Farron had a really good point. There are lots of different types of insurtech companies, and so the milestones are really different. So when you have a company where maybe they just sold their first policy, the milestones are different, but like the potential is huge, but the kind of VC firm that's going to invest in that is very different. Whereas I think my firm, which has $220 million under management, I would imagine that if we do end up investing in an insurtech type of company, it's going to be something that sells into insurance, whether that's, you know, an automation tool or something like that, in which case the return profile is just going to be a bit different.
No, yeah, I definitely don't think it's a fad. Like, you just have to look at China, right? Like, it's like Ping An and like Zhong'an, like those companies are worth billions of dollars. Like, unless there's like some crazy stuff happening, like it's already created wealth, right, and value. And then even like our fund, like RGX, like we're in like the 20% IRR, like a couple, you know, multiple on invested capital, like it was good. We don't publish it, but so yeah, like I mean, we were able to like extract money, you know, and generate free cash flow. So, and I think that will continue.
Yeah, I agree. I think the life insurance industry in particular has been very slow to innovate. I think there's huge opportunities there. Someone's going to figure it out. Whether that is a startup company or another carrier who better utilizes technology, I think that's a huge risk to our business. Or even a company like Amazon coming in, right? Which we'll see. But that would obviously be a massive risk. And so, yeah, I absolutely think this is here to stay. You know, the way we think about insurtech investing is that the companies that we invest in are probably going to create much more value that we, like from a business perspective than an investment perspective, especially considering we're managing, you know, $55 billion of assets and our fund is $100 million. It's a drop in the bucket. So, you know, I think there's real potential for some of these companies to come in and really add value to carriers and, you know, increase enterprise value very significantly.
Yeah, I think there's definitely long-term value, although I would caution that I think even within carriers, different carriers define value differently. You know, take fraud, for example, very important problem, much bigger problem, I would argue, for a primary carrier than a reinsurance carrier. Much bigger problem for a B2C carrier than a B2B carrier. You know, at the end of the day, you balance again severity and frequency. The more frequency you have, the more fraud, the bigger the problem fraud is. The lower frequency you have, the higher severity. fraud is probably inherently not that big of a problem. So I think it's important to figure out how you're adding value and how the carrier you're working with sees value. And I think on FAD, I definitely agree with Nitya. Valuation, I think, is a fad. In particular, I think the practice of trading your venture dollars for regulatory capital going full stack, I just can't see how that will work, and I think that's a fad.
So there you have it. Mostly not a fad, can create some solid long-term value, but some of the valuations are a little bit crazy. So I want to thank all of our panelists for being here and really supporting the community. Everyone can give them a round. And before you guys leave, I'd like to call up both Tony and Adam. They're going to make a couple announcements to the group, and from there we'll have some networking afterwards.
Hey everybody, my name is Adam. I'm from LiveGenic. A lot of you guys have probably gotten emails from me in the past. Thank you for attending tonight's inaugural InsurTech NY event. Your participation and support in connecting InsurTech startups and carriers and investors to accelerate the digital transformation of the insurance industry is very important. Before you go, there's the feedback forms. I saw a lot of you guys in the audience were already filling them out, so thank you for that. It's extremely helpful to ensure that we continue to improve and enhance our events and services later on. We will be sending out the invites for you to the next events. So don't register when they come around. Things up there. So finally, please go out and network. Just keep in mind, I think we have to be out of here by around 8:15. So just keep that timeline in mind. Otherwise, thanks.
And thanks everyone, and this all couldn't be done with all of our volunteers, so you'll note them by they have hanging lanyards. So if you see them, just thank them, and I appreciate you all coming out.